Good evening, Mrs. Martin here, Chapter 12, Lesson 2. Tonight we're going to be talking about determining payroll tax withholding. So the learning objectives for this lesson are to demonstrate the process for determining federal income tax withholdings, demonstrate the process for calculating Social Security and Medicare taxes, and explain the benefit of funding medical and retirement plans with pre-tax contributions. A lot of this lesson is going to be familiar again with the taxes unit in personal finance. We learned all about the tax forms that you get and that you file, but now we're going to talk about process for calculating those and how those come out of our checks. So as I mentioned yesterday, when you get your check and it's not the amount you thought it was going to be, you realize that there were taxes and deductions taken out. And we're going to talk about how we calculate those and why we have to calculate those. So federal income tax is withheld from employee earnings in all 50 states. Some employers in other states are required to withhold whether they're state, city, or county income taxes from employee earnings. And those taxes, the income taxes that are withheld, have to be sent periodically to the respective government agencies. So every so often, the employer has to send the taxes withheld for state income tax from their employees to the state, to the feds, to, if there's like a city tax, it has to go to the city, etc. So taxes based on the payroll of a business are called payroll taxes. So all payroll taxes are based on employee earnings. That's why it's so important that we keep accurate and detailed payroll records, because any errors in any of those records could cause incorrect payroll tax payments, and then it could hurt the employee at the end of the year when they're going to file their income taxes. Employees withholding allowance certificates. Have you ever heard of something called a W-4? You have to fill out the employees withholding allowance certificate when you start a new job, and that's the W-4. And a deduction from the total earnings for each person legally supported by a taxpayer, including the employee, is called a withholding allowance. So this information is pretty much used to determine how much income tax to withhold for that employee. And they're filing, that employee is saying on their W-4 when they start the job, this is how many dependents I have, this is how much I want withheld from my check. So it is very important when an employee starts a job that they have a W-4. They fill out a W-4 for every employee. So the amount of income tax withheld is based on the employee's marital status and the number of allowance. What is an allowance? Well, we've talked about this in personal finance, but an allowance would be a child, right? Someone who you are responsible for financially. So the most common allowance is a child. So I want you to kind of think about this in your head. So a married employee will have less income tax withheld than a single employee with the same earnings. So the larger number of allowances claimed, the smaller amount of income tax withheld. So the larger number, the more allowances we claim, the smaller amount of income tax that's taken out of our check. So most employees are required to have federal income taxes withheld from their wages. However, again, something we learn in personal finance, if you make less than the standard deduction, you can write down what's called exempt, and you do not have to pay those taxes. So again, last year, so this year for 2020, the standard deduction amount was $12,400. So if you do not make more than that, you could file exempt and not have any state or federal taxes taken out. So any amount withheld from an employee's gross earnings is called a payroll deduction. Federal income tax is just one of the many amounts that are withheld. We'll talk about some other taxes in this chapter that are withheld for all employees, but some employees choose to have certain deductions withheld. So some have retirement plan contributions, some people have health care premiums, etc. So this is a W-4. Again, the new W-4 this year, there was a new one for 2020, and it looks a little bit different than this. But this is what the standard one looks like. So you would have to put your information down, your Social Security. On number 3, you would tell if you're single or married. Number 5, you put the total number of allowances you are claiming. So if you're married and you claim your husband, if you have 2 children, you would put those there. On number 7, this is where you can say that you could write exempt if you made less than that standard deduction. I wish they would have the new form in there because it is actually very different this year. So this is the employee's income tax withholding for single persons. So we're going to figure out how much money is going to be taken out for tax. So what we're going to do is oopsie, let me go back. You would look. Now there are tables for various payroll periods. So this one is a semi-monthly payroll period, but there's different ones for biweekly, weekly, daily, etc. And there's different ones depending upon how you claim. So if you claim you're single, there's going to be a different payroll or tax withholding for that. If you claim married, etc. So because 3 Green's pay period is semi-monthly, they're going to use the semi-monthly withholding table. And so like in this case, let's say that my semi-monthly payroll period, I claimed 1 allowance. So I'm going to look at that 1 allowance, go down that column, and then I made $1,000. So I'm going to find $1,000. So it's between 1,000 and 1,020, and I'm going to find 1, and it's going to be $82 withheld from. That's the amount of tax that is going to be withheld from my payroll. Okay, same thing here for, this would be the married person's chart. So you can see here that you want to make sure you have the right table, and then you're going to locate their total earnings. You're going to find the number of withholding allowances they have, kind of drag your fingers across and down until you find that number. So I showed you on the single table, but this is showing you on the married person's table how to find the amount withheld. So let's talk about employee Social Security and Medicare tax. So the Federal Insurance Contributions Act, it's called FICA. They established a federal program, as you probably know, for old age, survivors, disability, and hospital insurance. So federal tax is paid for old age, survivors, and disability insurance. That's our Social Security tax. The federal tax paid for hospital insurance is called Medicare tax. So each of these taxes is accounted for and reported separately. So you would see those, if you looked at your check stub, you would see both of those listed. Social Security and Medicare tax are paid by both the employees and the employers. So the employers are required to withhold and deposit the employee's taxes, and then they have to pay a matching amount of those taxes. So if my employer withholds $85 from my earnings, they must also pay $85 of taxes for a total of $170. Social Security tax is calculated on the employee's earnings up to a maximum paid in calendar year. So the total gross earnings year to date for the employee is called accumulated earnings. The maximum amount of earnings in which tax is calculated is called the tax base. When the amount of accumulated earnings equals the tax base, no additional taxes must be paid. So Congress is the one who sets the tax base and the tax rates for the Social Security tax. for those to change at any time, it would be an act of Congress to change those. So as of right now, the Social Security tax rate and base are 6.2%. And the Medicare rate is 1.45%. So if I wanted to figure out, if I just hop back there, if I wanted to figure out my Social Security tax deduction, I would take my total earnings times 6.2%. So now, I want you to remember that there's lots of deductions that come out. So we don't take like our gross pay and then take out our state tax, take out our federal tax, and then use that net number to multiply to figure out our Social Security Medicare tax. We have to keep using gross pay. So the earnings, the total earnings times that. Total earnings times that. Okay? So then to get the Medicare tax, you would take the total earnings times the Medicare tax. So a retirement savings plan, these are voluntary deductions from earnings. So retirement savings plan approved by the Internal Revenue Service that provides individuals with a tax benefit is called a qualified retirement plan. You may have heard of a 401k. That's a qualified retirement plan sponsored by an employer. So you can't just go open up a 401k. It has to be sponsored by your employer. You can open an IRA, though. That's a qualified retirement plan that provides individuals with a deferred federal income tax benefit. So you can choose either a traditional IRA or a Roth IRA. The difference is a Roth IRA, you pay the tax now. That way, when you take it out, when you're retired, you don't pay tax on that money. You don't have to claim that as income. For a traditional IRA, you don't pay tax now, so you have the tax benefit now, but then when you take that money out, when you use that money when you're retired, you have to claim that as income and pay taxes on it. So a lot of this is, I know it seems like a lot, but it's something that you would want to talk with a financial advisor about, and where you think what position you're going to be in when you retire. So understanding this lesson, we just have a couple minutes left, so I'm going to kind of go quickly. Where does an employer get the information used to determine the amount of federal income tax to withhold from the employee's earning? So what form do they look at? They look at that W-4, the Employee's Withholding Allowance Certificate. So if you start a new job and they don't ask you to fill out a W-4, you should be saying, I need to fill out a W-4. Employee federal income tax withholdings are based on what two factors? The marital status and the number of withholdings. So those are the two things you will put on their W-4. Are you single or married? And how many allowances do you have? Now my husband and I have 2 children, and I could technically put a 3 on my W-4, but I only put number 1 because I would rather have more money taken out of my check now, and then I get more back at the end of the year when I file my taxes, but that's personal preference. Really, ideally, if you're doing it right, you shouldn't owe any money at the end of the year or get a refund back, but everyone does it differently. Does the employer or employee pay Social Security tax and Medicare tax? Both. Remember what I said, it's matching. So if I pay $85, my employer pays $85. So both. What is the difference in the tax impact of contributions between 401k, an IRA, and a Roth? So only contributions to a 401k and an IRA are deducted from earnings before payroll taxes. So what that means is, let's say I made $1,000 and I'm putting $200 into my 401k, or $100 into my 401k and $100 in my IRA. They would take that off the $1,000 before any of my payroll taxes are calculated. So you get that tax benefit. You don't have to pay taxes on that money. So that's why that is pre-taxed. Are the withdrawals from 401k, IRA, and a Roth IRA subject to income taxes? So the withdrawals from a 401k and IRA are subject to income taxes. Withdrawals from a Roth IRA are tax-free. And the reason that the Roth is tax-free, like I mentioned before, is because right now, you're taxed on that money. You're paying tax on that money right now. That way, when you withdraw it, when you're retired, you do not have to pay taxes on that. So I feel like I went a little fast because I have a 15-minute cap here, but I hope that you understand everything I talked about. So do On Your Own 12.2 and do Application 12.2. Thanks!